Hello and welcome to episode one of Talking Central Banks podcast with me, Karan Merishi. This platform is exclusively dedicated to everything central banking, monetary economics, and policy technicals for observers across the world. Today, we will be talking about the Bank of England and the ECB as part of our Euro Roundup. Our guest tonight needs no introduction. I am joining with Willem Buiter, who was formerly the global chief economist at Citigroup between 2010 and 2018, and a special economic advisor at Citigroup between 2018 and 19. Previously, he was the chief economist and special counselor to the president of the European Bank for Reconstruction and Development, and an original external member of the Monetary Policy Committee of the Bank of England. He was the Juan T. Trippi Professor of International Economics at Yale and has also been a professor at Cambridge and Princeton, among others. He is the author and co-author of 78 refereed articles in professional journals and 8 books. Wow, Willem, a truly distinguished career. Welcome to the show.
My pleasure. Thank you.
Thank you. So, Willem, let's start with the latest UK FPC. In its June 25 statement, the report discusses the impact of geopolitical risk on gilt valuations and DM exchange rates on the UK economy. What are your views on this, especially in the light of the multiple conflicts occurring in East Europe and West Asia?
Well, clearly, geopolitical uncertainty, driven in part by the Trump tariff wars, is a negative for the economy, both the demand side, the disruption and the uncertainty it creates will halt, slow down investment expenditure. And on the supply side, if trade wars become entrenched, supply chains could be disrupted or at least endangered. And all that, of course, can lead to great exchange rate volatility.
Right.
We have seen really remarkably little of that so far among the major currencies.
Right.
The US dollar, in fact, has on net depreciated somewhat.
Right.
Sterling, in terms of its effective exchange rate, since the beginning of the year, hasn't really done anything. So at the moment, the disruptions in financial markets through exchange rates or through asset price and interest rates have been contained.
Right. Uh, Willem, what kind of impact do you see on money and repo markets in the near term? I think the volumes remain pretty decent for now, and liquidity appears to be sufficient in the system.
Yes. Again, we have not seen any major negative fallout of the trade uncertainty and the more
Yep.
and the wider economic uncertainty, I mean non-trade related barriers to economic activity, migration,
Right.
threats to certain kinds of capital investment. Yes, they're all there. But so far, I haven't seen any major impact on the short-term money markets of
Right.
the leading economies.
Speaking of which, Willem, the British yield curve, I think it seems to be steepening lately, ever since the tariff impositions by US administrators, as you were
Mhm.
mentioning earlier. What action do you think the BOE must immediately take to soothe the market, in your opinion?
Well, it all depends how you interpret this steepening of the yield curve.
Right.
If it is simply the market anticipating higher future inflation,
Right.
say because The UK, which has so far accommodated all the demands of the US, if it were to switch over and start imposing tariffs itself on
Right.
the US and possibly on other trading partners, I don't think this is likely, but that could be one
Mhm.
source of sort of political unrest-driven fear of inflation. And for
Right.
the rest, I think that there may simply be the recognition that, especially in the UK, inflation is far from being squeezed out of the system. We're in the high threes still
Right.
on the core CPIH, which includes
Mhm.
sort of housing services of owner-occupiers. Its
Right.
core inflation is now running slightly above 4%. With a
Mhm.
target at 2%, that definitely should mean that there is little prospect of
Mhm.
further rate cuts. The last one, I think, was a mistake, but certainly I don't anticipate any more. And the only other reason for the increase in the steepness of the yield curve
Right.
is that
Right.
sovereign risk premia are rising for reasons that have very little to do with trade unrest, but have to do with the fiscal unsustainability of the positions
Right.
of many of the leading nation governments, including the Brits, the French, the
Mhm.
Japanese, and I
Yeah.
would say the US, yes.
Agree. Also, Willem, what impact do you see on the high yield segment? I think a lot of folks out there would want your perspective on that.
The high yield
Yeah.
market. Well,
Yes.
um, I think current occupants of the high yield spectrum are likely to get new neighbors as more low and medium yield
Yeah.
debt uh, turns into higher yield debt because of fear of higher inflation and fear of, I think, sovereign debt uncertainty. The inflation risk, of course, can be hedged by going for index-linked financial
Right.
instruments. But that, of course, does not address the debt restructuring risk
Right.
that has to be present everywhere. Yes.
Well, the UK Financial Stability Report recently hints at increasing loan to income ratios to aid banks increase their businesses. And I'm quite surprised, actually, given the
Mm.
timing of this. Do you think it's a right move in the current job market, and whether the Bank of England must intervene now that financial stability is back in its fold?
I mean, raising the loan to income ratio that basically means making it possible for people to take out larger mortgages, right,
Exactly. Yeah.
is a financial risk boosting
Hmm.
decision, which is very inappropriate, especially at this time. Yes, I do not understand how the must be the financial policy committee of the Bank
Hmm.
of England decided that this was the right thing to do. I'm sure that the banks would be clamoring for it. They want to lend more.
Hmm.
But
Yeah.
no, we're going to strain the solvency of households and corporations who will undoubtedly be seduced into taking out larger loans and mortgages and will underestimate the risk this poses. And well, I think some lessons must have been learned from the great financial crisis of 2007, 2009, um, I don't think quite enough has been learned. I mean, many central bankers in 2008 didn't know what a CDO was, right? The collateralized debt
Yes.
obligation. But I'm pretty sure that with the growth of non-bank financial intermediation, that the transparency of the risk positions of lenders and borrowers in many financial markets is leaves much to be desired now.
So, Willem, given this background, do you think the provisioning costs for banks would be increased given the risk profile at this point in time?
Well, I don't think, I think they should be increased, but I don't think they will be. This will only happen when something unpleasant, which directly threatens the bank's balance sheet or its ability to fund itself. Until that happens, I don't think we're going to see any restraining capital measures. Yeah.
So they're probably waiting for a trigger event to happen
Yes,
before they do that. Yeah.
absolutely. Yes.
Yeah. Recently, Willem, there was a discussion regarding stablecoins taking over significant settlements in the wholesale markets, potentially replacing central bank money. Does this worry you in any way?
Well, if it were to happen, I think it would be potentially worrying unless it's very carefully regulated and supervised. I think the stable coins, in my view, is the central banks do the sensible thing and create retail central bank digital currencies, interest-bearing ones, that can be transacted with both on on web and off web, so to speak, and
Right,
that have no caps on the size of transactions, the size of the accounts. But if that were done, then the central bank interest-bearing retail digital currency would be a very effective competitor, not just for current demand deposits, but also for stable coins. And if, and here comes the regulation issue, I would only allow two stable coins, which means a, a cryptocurrency tied to, let's make it the dollar for concreteness, but any leading currency or some commodity
right,
will do. Let's take the dollar. Right? If it can really be exchanged instantaneously on demand in any amount, then it has to be backed 100% by either central bank reserves or short duration treasury debt. And
right.
so I would also allow it to be interest bearing. The Genius Act in the US, well, it's very loose on the regulation of stablecoins in many ways. I mean, it allows them to be backed by assets denominated in foreign currency to some extent, which is completely nuts. But they still don't allow them to pay interest, and I would definitely do that. But I would think that if we have these fully backed
Yeah.
stable coins, we could get a new means of payment that outperformed our current ones because the main margin for profits would be the superiority in the transfer and exchange mechanism that these stablecoins bring. So I would also, of course, this is a separate issue, but do away with with paper currency and coins at the same time that I introduced central bank digital currency and possible stable coins, so that if necessary, interest rates could go deeply negative, which
Hmm.
they should have been
Interesting.
in the between the great financial crisis and the COVID recovery, so to speak, right? When the central bank rates almost everywhere were at or near the effective lower bound, just no lower than minus 75 basis points in Sweden, anywhere. But I would definitely hope that the central bank digital currency would not just be an effective means of payment, domestic and international transactions, retail and wholesale, but it would be um, um, an, an effective means of stimulating the economy when inflation is below target, the neutral real interest rate is very low or even negative, and there is excess supply in the labor markets and the good markets. So I think there's real prospects that we'll see, I hope, some combination of CBDCs and privately issued stablecoins, properly managed and regulated and supervised um, in, um, in most of the world. Yeah.
Interest bearing or not, Willem, but what are your views on stablecoins impacting the BOE's financial stability mandate? Uh, can the segment have a contagion to London's financial economy amidst DM currency instability at this time?
Only if you design them to potentially unstable. If they are convertible on demand instantaneously at a fixed price into, say, dollars, or could be sterling, right? Then they would have to be backed 100% by central bank reserves or short duration treasury debt. Then, therefore, there would be no run risk um, or associated with that. So they would not be a source of instability. The way they have designed in the Genius Act the American stablecoin, definitely because they have this crazy property that they uh, um, they can be backed to a certain extent by foreign currency denominated assets, non-domestic sovereign liabilities. That's insane, and that is a, a real potential threat. But properly designed, it would simply be a superior form of demand deposits.
I know, Willem, you just talked about this when you were discussing inflation, but the BOE's MPC in its June meeting decided to maintain rates, despite over a quarter of its members suggesting a cut of 25 bips. And I think the idea is that despite the economy showing signs of a slowdown amid a slowing job market, the committee wants to ensure that the second round effects do not deviate the ongoing convergence of the inflation range to the long-term target. Do you think, Willem, that we are already in the narrow range and that further resistance to cut rates is futile and in fact damaging to the still recovering economy post-COVID?
Yeah. I mean, remember at the last meeting, the Bank of England actually did cut. There was a 5-4 majority.
Right.
Two members sort of internal members, a, a deputy governor, and the chief economist, voted to keep rates constant. And just a 5-4 majority voted to cut it. I think that was completely inappropriate. As I said, inflation is well above target and it shows no sign of slowing down in the price field. Labor earnings growth is coming down a bit, according to the most recent data, but is still well above 5%, the annual
Right.
rate, which, given British labor productivity growth, is definitely not consistent with 2% inflation. And the real economy, yes, it's weakened a bit. Unemployment rate has ticked up, but it is still at levels that cannot be far from any reasonable estimate of of the natural rate of unemployment, the NERU, whatever it is. So I think
Right.
there's absolutely no case. Remember, the Bank of England's mandate is not like the Fed, which has price stability and maximum employment symmetrically. In
Right.
for the Bank of England and indeed for the ECB, the Bank of Japan, inflation uh, under control, price stability comes first. And you get expressions like subject to price stability being achieved, go for all things bright and beautiful that the government wants, including growth and employment. And the same in the for the ECB and the Bank of Japan. So there is absolutely no justification when inflation is so far above target, shows no sign of slowing down, and when there is no convincing evidence of a serious slowdown in the real economy that will create excess capacity that will itself drive down inflation, uh, um, since that's not the case, there was no, I think, reasonable argument for the Bank of England to cut rates. But they did, and they will undoubtedly regret it.
You mentioned, Willem, that the internal members are convinced that rates can be maintained.
Not all
Uh,
internal
some of them, at least.
sorry, yes. There were
But
two members who wanted to keep rates constant, and then three internal members want to cut them, yes.
what is the narrative that they're trying to build and communicate to the market, Willem, given this thought process that they're
They
following?
must just have a different view of where the real economy is going and about the temporary and transitory nature of the current uptick in inflation. And it's um, uh, sticking above a level that is
Mm.
anyway compatible with the inflation target, with the price stability target. So I yes, they must, I think, have a very different view of the economy and the transition mechanism.
Uh, Recently, Willem, especially post-COVID, a lot of central bankers have burned their fingers with the inflation in transition narrative. Do you
Mhm.
think this divided opinion at the BOE is hinting at that confusion?
No, I mean, undoubtedly, and no, it is true that economics is a difficult field. It's very difficult to get things right. Empirical regularities jump out of the window on a regular basis. But and there is a good argument, for instance, this is not so much relevant in the UK, but in the US, where the tariffs have gone up, that this would lead to an increase in inflation, which, unless it gets embedded in expectations and in long-term contracts and through indexation would be transitory, temporary. But the inflation in the UK and the Eurozone is not driven by tariff increases. They've cut tariffs to
Yeah.
please Donald Trump. And so I think the argument there is that the inflation spike following COVID, which was the result of wildly excessive, the expansionary combined monetary and fiscal policy, turns out to have been embedded in expectations, and that the economy, even now, is running at a level that probably generates excess demand driven inflation as well, that we are not
Right.
yet above the natural rate anywhere in the EU, in the UK, in the US, or in Japan.
It brings me to the macros, Willem. While the euro area expanded by 0.6%, the UK economy expanded by around 0.7% in quarter one of 25. Nevertheless, the euro area, it seems, is experiencing a lower inflation print as compared to the UK, as you're pointing out,
Mhm.
with a more stable job market in the former. With this in the background, what accounts for the much higher policy rate in the UK than in the euro area?
It is really very striking, the difference now. It's
Yeah,
okay, down to 4% now in
exactly.
UK, but 2% for the deposit rate in the euro area. And inflation, is HICP inflation, is at 2%, and core inflation, I think it may be 2.1%, but it's also right at the target. So they're on target. Their economy, well, it has a higher unemployment rate by international standards, 6.2%. It's a historic low for the euro area. So it is undoubtedly at now, and it could well be below the natural rate. So I expect, unlike the forecast of the ECB, which is for inflation to fall below 2% to 1.5%, I expect a more likely uptick in inflation there. But it's still hard to argue why inflation would be so much higher in the UK. One argument could be that productivity growth in the UK has been even worse than in the euro area.
Right.
So any growth in aggregate demand, certainly 0.7% in Q1, right, for the UK, would have been in excess of the growth of potential output, and therefore would have um, increased the output gap in the sense that increased inflationary pressures. And I think that's probably true. I mean, the economic damage done by Brexit
Yeah.
is still not um, you know, processed. The economy has not redesigned, rebalanced, restructures itself to cope optimally with this very different new trading environment, migration environment, and indeed, I will say to a certain extent, um, financial management environment. So yes, the UK, I think, probably has materially worse supply side than the average of the euro area. And this accounts for
Hmm.
the higher inflationary pressures to a significant extent.
Right. So since you mentioned, Willem, both the perspectives, the demand side and the supply constraint problem that the UK is facing at this point in time, especially after Brexit, what kind of policy response do you think would be a kind of a sweet spot to manage both these problems?
Well, that the most open and far-reaching trade deal with the EU that you can imagine, basically just restore open and free trade between
Mm.
the euro area, the EU and the UK, and I would say also allow migration to flow freely again. That will be mainly supply side measure. It would,
That's a contentious issue.
oh yeah,
That's a very contentious issue, yeah.
yes, but being a professional immigrant myself,
Mhm.
I've been an immigrant in one, two, three, four countries since the age of six. So I, mm, I think there are advantages, not just to the immigrants, but also to the countries receiving them to properly managed immigration. But yes, I and for the rest, I think it is very important from a longer and stability perspective um, to get more serious about the post Basel III regulation of the non-bank financial sector. We're still too focused on the banking sector. I know it's still the majority of financial intermediation in much of the euro area, but it's coming down quite rapidly. So get just tighter controls on on private financial intermediation. There is always enormous political pressure on the government of the day to relax, permit things that allow people to borrow more, to lend subject to lower standards and all that. None of that. Finance is trade in promises. It is inherently unstable and needs to be supervised and regulated tightly and closely. Finally, achieving fiscal sustainability, while it may not do any any good to the demand side of the economy in the short run, because it would require both, I think, immediate fiscal tightening and the credible announcement of future fiscal tightening, that I think is essential to get to a sustainable path, both for output employment and then for inflation.
Interesting. By the way, Willem, the USD too has been losing strength by way of diversification hedging. Any thoughts on that?
In the US dollar,
Yes.
uh, uh, yeah. Well, I do think that the the future of the dollar is subject to great uncertainty, and for many years, in part because of the continuing attacks of President Trump on the chairman of the Fed, Jerome Powell, and also because he's likely to be able, when Powell leaves, presumably as chair in January 2026, to appoint somebody who's significantly more dovish. And even if it is Stephen Moran, somebody who, not that long ago, made some crazy proposals to mandate conversion of foreign held US Treasury debt securities
Mhm.
into, I don't know, 100-year zero coupon bond or something. I mean, there's something that really amounted to, I think, a partial repudiation
Right.
of US sovereign liabilities. Now, he stepped back from that since, but the notion that somebody like that could be part, and in all likelihood will be part of the board, and could even be the next chair of the board, then that is very worrying. So all these things, the executive leaning on the Fed for greater relaxation of monetary policies, the threat to the independence of the Fed, and the risk that some outlandish players may be co-determining U.S. monetary policy in the years to come. I think that's enough to account for a weaker dollar.
Right. Yeah, that's point well taken. Coming back to the UK, Willem, the market participant survey, or the MPS, expects the inflation print to peak at 3.4% in quarter three of this year.
Mm-hmm.
Despite this, median MPS forecast is a 50 bips rate cut during the rest of the year. And I think you were also alluding to that previously.
Mm-hmm.
How does this impact the BOE's forward guidance strategy, according to you?
Well, if they plan to cut by 50 basis points in the rest of the year, then um, they will probably, if there's a majority in favor of that, um, wish to inform the market that unless there are material changes in economic circumstances, that's what they will do. Huh? Maybe have a cut today, but we expect to see further cuts, provided the inflation does so and the real economy is no stronger than so and so. So that's well, forward guidance only requires that the Bank of England be able to predict its own behavior accurately. It doesn't mean, of course, that they predict the economy accurately.
Yeah.
So we'll see. I don't see, given the fact that the last cut was only 5 to 4, that we are likely to see strong hints of, given our forecasts of inflation and unemployment and the exchange rate, whatever, this is the likely path of short-term policy rates. I don't think that's likely. I don't think the majority for such forward guidance is there at the moment.
Right. I think the expansion in household consumption and inventory buildup in the UK economy is hinting front loading, given the impending US tariff imposition. What material impact would this bring to growth maximization and price stability mandates for the BOE, in your opinion?
Well, I mean, households in the UK would not front load purchases because US tariffs. I mean, households in the US could be expected to do that. But as I said, in the UK, tariffs on the US exports to the UK have in fact been lowered, basically thrown out of the window. And I do not see this as as an enemy of that front loading because there are no events that can be easily anticipated unless they expect the eruption of a trade war where the UK aggressively raises tariffs on on all its trading partners, which is completely out of the question. So I do not see any strong front-loading argument for household purchases and inventory accumulation in the UK.
We economists often talk about this concept of households also owning businesses.
Mm-hmm.
So even if the households are not directly impacted in terms of the impact on their demand or consumption, it could be from the perspective of the businesses owned by the households which are impacted by the tariff wars.
Yes,
So
no,
from
undoubtedly, yes. Um,
Mm,
exporters to the US, would be impacted and could respond, but they would not respond by increasing their inventory accumulation. They would respond by trying to beat the tariffs, um,
right.
and therefore sell more, run down their inventory. So yeah, I I find it hard um, to think of a sort of positive shock to either household demand or corporate demand coming from any ongoing or recent um, trade turbulence or the anticipation of more of it to follow.
Right. Coming to the ECB, Willem, recently Vice President Louis de Guindos said that euro exchange rate beyond 1.2 might be complicated. What is your assessment, and what, in your opinion, should the ECB do in this matter?
Well, I think that the uh, appreciation of the euro that has occurred, but has been quite modest, um, mainly reflects uncertainty and doubt about the future cost of monetary policy in the US and even about Fed operational independence. There's they could respond to it if you worried about that uh, by cutting rates, but I don't think there's a case. There's a case for that. I do think that they should probably just have to learn to live with
Mm,
a rather
yeah,
stronger euro, at least bilaterally vis-à-vis the dollar. If the appreciation becomes a general one, not limited to dollar exposure, there might be a case for either rate cuts or other interventions. I don't think old-fashioned foreign exchange market intervention by um, selling dollars and sorry, buying dollars and selling euros is going to be a very effective instrument. Um, I would just, I think, wait and see and manage the unavoidable, albeit relatively modest, consequences of possible further euro appreciation, and not view it as a instrument, unless it's across the board and material, for loosening monetary policy further. They already have a very low rate of interest. No, 2% is, unless you believe that the neutral real interest rate in the euro area is zero or lower, right?
Yeah.
Monetary policy is actually expansionary in the euro area, when I think it should be neutral.
From that perspective, Willem, questions were raised during the ECB press conference recently regarding liquidity slipping from ample to excess in the near term. What, in your opinion, would be the impact on the interbank market? And what should the ECB do in terms of tool deployment in this regard, given that uh, uh, given the perspective on rates that you are alluding to?
Well, yes, um, given the strength of the euro, this may not be an ideal time to shrink the balance sheet, and by selling sovereign debt assets, and shrinking central bank deposits with the central bank, a commensurate way. So I would probably, until this issue of excessive euro strength is settled, not tighten monetary policy through reducing the ample availability of euro liquidity in the ECB currency market, so to speak.
Coming to the structural issues with the BOE that you wanted to discuss, Willem, you often talk about the fundamental differences between the approaches followed by the ECB and the Fed as compared to the BOE. That is, emphasis on consensus in the case of the ECB and Fed versus accepting disagreement in the case of the BOE. Your comments on this?
Yeah, I'm really afraid of groupthink in any body, collectivity that takes important decisions. The size of the ECB's governing council, or is it again? Is it 21 or 22? I think it's 22 voting members at any one point. It's ludicrous, right? That's not a way to have a meaningful discussion and a meaningful decision-making body. In the US, the size of the FOMC, the total FOMC is 19 people. Of course, only 12 of them vote. The 7 Fed governors, and then 5 of the 12 presidents of the regional central banks. The Bank of England has a significantly smaller decision-making body. MPC has 9 members. I still think that it's probably slightly too large. I think 7 is my optimal number for having a range of possible views and time and opportunity for everything, for everybody to intervene and to give to the others their 2 cents worth, their insights and their reservations. But as I said, the ECB emphasizes consensus so much that they don't even vote most of the time. In fact, I think all the time on monetary policy decisions, which
Right.
is really lazy. I mean, economics is, even if everybody's agreed on the objectives completely, there's no problem there. View of transmission mechanism of monetary policy, view of what drives inflation and subject to that, output and unemployment. It's the notion that you could get a unanimous view on the appropriate policy when reasonable views of the economic transmission mechanism, the monetary policy transmission mechanism, and of the operation of the economy are so widely, this should be so widely dispersed because there is no consensus and unanimity. This is not rocket science, and the same with the Fed. People are sort of shocked at having two dissenters out of 12 voting members of the FOMC. And the notion that there might be three if Miran gets appointed before the next September meeting is really completely beyond the pale. No, if there is consensus, that probably means that most people got it wrong, right? And consensus in an imperfect science, applied science like economics, is asking for the impossible and pretending you can get it, or orchestrating the operation of your decision-making committees to get unanimity is really, really ridiculous. The chair should not feel bad about getting outvoted, in my view. When I was on the MPC, this was the first independent 3 years of the Bank of England. The governor, Eddie George, was never in the minority when they voted. But the reason was that they always voted last.
Right.
So if he thought that after making his views known, which he did, of course, during the meeting, if he knew what he wanted, if the majority was against it, wanted something else, then he would go to the majority. Not every governor of Bank of England since then has followed the same rule, but I think, yeah, unanimity, consensus is stifling and likely to increase the likelihood and severity of potentially serious and costly mistakes.
Mhm. They probably need lessons from the game theory
Yeah. Oh, yeah.
in
No,
central
there
banking.
is a very interesting literature on that. My wife, Professor Anne Seibert, has just written yet another paper on the optimal size of decision-making committees, and
Right.
all these things are discussed, very intently and in a very interesting way. So yeah, there's a whole literature also from outside economics, from social psychology,
Mhm.
dealing with optimal design, including size of committees.
Right. Mhm.
I can tell you that certainly the Fed and most clearly the ECB are not anywhere near the optimal size or modus operandi. Yeah.
Right. Right. Very interesting, Willem. Regarding your eye-opening article published in Project Syndicate recently, titled "Are Central Banks Betraying Their Mandates?" You have mentioned here that total factor productivity growth in the UK region is slow.
Mhm.
Why do you think so, and what would be the probable reason?
Well, one reason is um, is the legacy of Brexit and the imperfect um, adjustment, restructuring of production and markets to deal with the new reality that they're locked out, sorry, that they're no longer an integral part of their main market. For the rest, I think there are many other reasons. I think the size and composition of public spending, underinvestment going back decades now in infrastructure, roads, railroads, and all that. I would say that there may be problems with incentives and the structuring of education, so human capital formation, the British economy, even if you compare it sort of sector by sector, industry by industry, underperforms most of its global competitors. And I think, apart from sorting out a close but independent relationship with the EU, to try and design tax and public expenditure systems in ways that do maximal good rather than maximal damage. And so I would definitely get deregulation of housing markets, attack the NIMBY problem, right? Other obstacles to profitable, the creation of profitable but risky enterprises, making it possible to fail but not to be crushed in business. The cost of failure in much of Europe, not just in the UK, is way too high. And for businesses, this often shows up the fact that even if they invested in a completely unsuccessful new high technology enterprise, and it goes bust. They're stuck with the overheads of having to keep or pay the workforce even after the venture has failed. This is a cost,
Right.
if you want to limit the economic damage to the redundant workers, this is a cost that should be borne by the public purse, not
Mhm.
by the enterprise that initiated the innovation, the unsuccessful innovation. So, yes,
Right.
so we must make it easier to engage in risky but potentially very profitable and productive economic activity.
Right. Right. Very interesting, Willem. Well, that's all I have for today. Thank you for your time, Willem, and being part of the show.
It was
I
my
am sure
pleasure.
our audience would have gained tremendous insights, enriching their knowledge pool. Thank you once again for the honor, Willem.
Thank you for having me. It really has been a pleasure and an honor. Goodbye.
Thank you. Thank you. Bye.